Hello, everybody. Joseph Smith from Travel Talks. It is July 12th, 2025. Last week, the big, beautiful bill was passed. Maybe beautiful like the picture on my candle or even the way it smells. Well, the question is, how big and beautiful is this for you? And that's what we're going to explore today. Now, this is going to be like a 15-minute video, so, get comfortable, get something to snack on, or get your favorite beverage. Just don't get a general anesthetic, because that's not going to help you with this. But there's some provisions here that may benefit you. But in order to explain some of the big parts of this bill, we got to go back to 2018, during the first Trump administration. If you recall then, there was a major tax bill that was passed that did things like doubling the standard deduction, getting rid of job expenses, and a host of other things, including lowering the tax rates, giving self-employed individuals a 20% deduction on their net income. A lot of good things business-wise. But one of the problems with that bill, because it had to meet the budgetary requirements, was that many of the provisions were set to end at the end of this year, 2025. So one of the major components of the big, beautiful bill, and by the way, that name's going to get changed because that's more of a monkier for being able to identify it. One of the major components of this bill is taking those changes and making them permanent. So the lower tax rates, the doubling of the standard deduction, etc., that is all going to stay, including W-2 job expenses. They're still not deductible. And for the foreseeable future, unless the laws change, they're not going to be deductible at all. They may be deductible at the state level, because you remember states don't have to follow federal law, even though many of them do. But what are some other provisions with this bill that can help us other than that? Well, one thing is what I call the resurrected provisions. We had some things during COVID in the initial part of the first Trump tax bill that expired later on. One of them in particular is the mortgage insurance premium deduction. When you are itemizing, or if you are itemizing, one of the things you can use is your mortgage interest and your real estate taxes. In 2018, and for about 2 years, we were also able to add mortgage insurance premiums to the interest. And then that fell away, but now it's been brought back. And if you have less than 20% equity in your home, generally your mortgage requires you to insure the mortgage, especially for that part that is below 20% equity. So that is something that has been brought back. Another thing that has been brought back is, if you remember, there was an allowance for charitable deductions, even if you didn't itemize. And yeah, it was a small amount, $300, $600. Well, this has been brought back, but even bigger. So what we have now is that if you give to charitable organizations, if you donate, whether it be cash or non-cash items, you can deduct up to $1,000 as a single, $2,000 jointly, if you file jointly with a spouse. You can deduct that much without having to itemize. And the educator's deduction, which is a little bit similar to that for those teachers and those that are involved in education, they have been allowed up to $300 of a deduction on their return for any items they buy for the classroom. Well, that has been enhanced as well, too. So charity is definitely one area we can benefit from, because in the past you had to itemize and many people were just not doing that. So the charitable deduction didn't have any benefit on the tax return. Now we have $1,000 at least for a single. And if you're looking to give about $2,000 towards the end of the year, split it. Or if you're giving $4,000 between you and your spouse, split it so you can be able to use it on each calendar tax year. You probably heard a lot of talk about Social Security taxes being eliminated. Well, they didn't get that far. But what they did instead is decide to add a $6,000 deduction for anybody 65 or older. So for the average Social Security payment being between $15,000 and $25,000, giving an additional $6,000 deduction, went about a third of the way on that, but it wasn't exempted in its entirety. One change that will benefit quite a lot of our clients is a change in what's known as the SALT deductions, state and local income tax. On your federal return, you are able to itemize state withholding, those pesky driver's license taxes that you have to pay to renew your tags in half the states, and real estate taxes, anything that was related to a local or state levy. But when the first tax bill was passed in 2018, it put a cap on that of $10,000 per return, whether you're single or joint. That has now been raised to $40,000. Generally, people who live on the coast or have high mortgages with high real estate taxes and states that have high taxes were hurt by the original bill. So this is not being given unlimited. It is given up to $40,000 if you stay within the income limits. So what in 2018 was an increased tax on the rich has now been mitigated a little bit, but you still can't earn so much that you don't get the benefit from the enhanced SALT deduction. But I suspect about 15% of our clients are going to benefit from this increased limitation. Child credit. If you have a child, it's $2,000 a year. If the child is under 18, it's now been raised to $2,200 and will now be indexed each year for inflation instead of staying static year to year despite the ups and downs of cost of living. Taxes on tips. This is another thing that was being talked about quite a lot, and it has been passed. Now, there are income limitations here. You cannot make over $150,000 single, $300,000 joint, but the first $25,000 of tips are now excluded from tax. Now, they're still subject to Social Security and Medicare taxes. And you will still include this amount when you first start your tax return, but further down the return, you're going to be able to deduct your tip portion of your income. Now, just like some of these other provisions, are we going to be able to tell when we file our returns what part was tips? Usually on the W-2, the tips were sectioned out. They were called Social Security tips. But there are certain situations in which tips are pooled or whatever, and they are just treated like regular income. So there's going to have to be a reporting mechanism for everybody to benefit from this. And the IRS has a lot of work in issuing guidance in the coming months. Don't expect it to happen in the middle of summer break. It's not going to happen until a couple of months from now as we get closer to the end of the year. Tax on overtime. We heard a lot about eliminating taxes on overtime. Well, we have to an extent. The first $12,500 of overtime premiums is now deductible if your income is not too high, $100,000 for singles and $200,000 for joint filers. Now, I emphasize the word premium. First, overtime subject to Social Security and Medicare regardless, but we're talking income tax, not payroll tax, which is what that is. So it's the premium. So let's say you make $40 an hour. If you work overtime, you get a minimum of time and a half, which means $60. So let's say you work 1 hour of overtime and you get 60 versus 40. You will be able to deduct the 20 premium that was added to your base wage. Not the whole, but the premium. Now, if you are an Alabama resident, Alabama started this deduction sort of like a trial about 1.5 years ago, and they exempted all overtime wages from income. It didn't even show up on your W-2. But the federal version of this only focuses on the premiums. If you want to buy a car and it is primarily assembled, the final assembly is here in the US, if you are within the income limitations, you can deduct up to $10,000 in interest. And of course, it has to be an eligible loan, not a loan from your uncle or something like that, a loan that can be tracked. But you can deduct up to $10,000 of automobile interest. And you know, this is a throwback to the 1990s. I remember when I first started looking at a tax return. I'm 60 years old, so I filed my first return like 1980. I remember my mother putting down automobile interest on the loan as a deduction. And in crazy places like Puerto Rico, it's always been there because they want to encourage people to buy new cars all the time. But it's there now, especially if you're getting ready to go on the road to work and you want to get a newer car. Well, you got an interest deduction here as well. Another provision of this is sort of an interesting one. It's called a Trump account. What is a Trump account? If you're born from 2025 on, you now have an account set up for you in which anybody can donate $5,000 for you to use for things like education, etc. And then when you get over 18, it sort of opens itself up to what you want to use it for. Now, there's a lot of intricacies about this new account. We're going to get guidance. We're going to narrow it down to what you can and can't do. But one really interesting thing about this is when you're born, you get a $1,000 credit. The government is going to drop $1,000 into this Trump account, and then you get to build it from there. Now, one interesting provision about this is you're not taxed on what you put in, but you're taxed on the earnings, but not regular tax rates. It's the capital gains rate. So it's going to be treated like property that you bought and later sold. But it is a very interesting thing that I'm sure the financial planners are all going to start incorporating this as a part of educational savings for children that are born this year and coming forth. And speaking of educational savings, that brings us to the 529 plans, which most people are more aware of. A 529 plan is a state-sponsored savings plan in which when you donate to it, all of the earnings grow tax-free if you pull them out for educational purposes. And they're very flexible. You can change beneficiaries. I had one for my 2 boys as they got older, and I had one in particular who had to go to a special needs K through 12 school. Now, the reason I bring that up is because in 2018, in the first Trump tax bill, they expanded 529s to go beyond college. They then added K through 12 private school, which worked out very nicely for me because my youngest started going to a special needs private school in 2018, right when this bill was passed. Well, now they've been expanded, not only for college, not only for K through 12 private school, but also for homeschooling expenses, and get this, trade school. Non-tuition credit granting schools, cosmetology, welding, apprenticeships. You can now use these savings accounts for that. It really expands the definition of education and keeps us from thinking that college is for everybody, which it isn't. And it opens up a lot of opportunities if you can get these started. If you have a newborn, get a 529 plan going. I tell this to all of my clients, get it going now. Let mom, dad, grandparents, whomever throw in some money towards your child's education. Energy credits. If you don't buy that EV before September, you're not going to get the credit. And then the little machines, the things you would plug the car in, the credit for that ends next year. All of the house credits, solar, all the rest of them, for the most part, die at the end of this year. So if you're going to do any kind of expenses like this, let's do it now. Adoption credits have risen $5,000. And then the last one that I will bring up is gambling. Now, let's say you go out and wager $5,000 on table games, whatever, and you lose $5,000. Well, you can deduct up to your winnings on your tax return. The problem is you got to be able to itemize. Well, let's just say you do. You have enough to itemize, and you win $5,000 gambling, and you get to deduct $5,000. Okay, wipes it out, right? Well, that's changed. You only get to deduct 90%. So that means you can only deduct $4,500 of the $5,000 of winnings. And there's a lot of talk of how this is going to change some of the casino loyalty programs, but we'll see how this all pans out. Generally, if you go gambling, it's for the thrill, right? So it's not necessarily going to change this. Unless you're a professional gambler, then you're not subject to these rules. Finally, the CAV-A. There are other provisions in here that I don't have time to talk about. One in particular, the way you pay back student loans is going to change. You may want to do some reading on that if you're going to be taking out loans shortly. But finally, this is all federal law. States are going to have to decide whether to follow. Now, some states are what we call conformity states. They have written into their state tax law that whatever the IRS or whatever the federal government does, they will do. But there are plenty of others that either follow it, but it must be approved legislatively, and then some that don't follow it at all. They handpick sort of cafeteria style those things in which they want to follow. And one thing to keep in mind, your W-2 is going to have to be able to show overtime, tips. There's going to be some reporting changes along the way here that we don't know how it's going to happen. And one thing we will suggest that if you do work overtime, keep your pay stubs. You may want to, just in case you have an employer that doesn't have the most robust payroll system, keep a copy of your pay stub so you can be able to isolate the overtime. Some of your pay stubs will do it like a year in. It sort of tallies it as it goes. But if it doesn't, you may want to get that record from January forward. That's a lot. And there's still other things we can talk about, but for the sake of time, I want to stay under 20 minutes. I promised 15, but here we are at the 19-minute mark. If you have questions, you want it a little bit more specific, go to info@traveltax.com. Feel free to send us a question. If it comes to something like this, we want you to get the information in hand so you can save money. Until next time, more bills to follow? Hopefully not. We got enough to worry about now for the end of the year. Have a great summer. We'll talk to you soon.